Good evening, friends, and thank you for joining us today for the launch of 5paisa's Wealth Portfolio Advisory Platform. Retail investors often get the short end of the stick as they have little to no access to specialized portfolio advisory services that can help them enhance their investment journeys and also create wealth. 5paisa Wealth, with its portfolio advisory platform, aims to bridge this gap by enabling investors to invest in curated portfolios that are created by some of the industry's best portfolio managers. And joining us today for this grand launch is Mr. Pankaj Murarka, whose Alpha Core and Satellite portfolio will now be available on the 5paisa portfolio advisory platform. Pankaj has over 25 years of experience in Indian equities with an excellent performance track record. He has worked with some of the leading financial institutions in India, including Motilal Oswal, Rare Enterprises, Merrill Lynch, and Axis AMC. Welcome, Pankaj, and thank you so much for joining us today for this launch.
Thank you so much. Thank you very much for inviting me for this launch. It's indeed a privilege to be part of the launch of 5paisa Wealth.
All right. So, Pankaj, I think there is inarguably investors are now looking for more nuanced investment solutions. They're looking to create wealth, improve their financial planning and investment journeys. But not everybody has access to the entire suite of products and solutions. So, from that perspective, do you think the 5paisa Wealth platform, through these curated portfolios, can meet these more nuanced requirements of investors?
Oh yeah, absolutely. I think it's really path-breaking because one, I think with launch of 5paisa Wealth, I think essentially it allows to take the whole concept of financial planning and wealth management to the remotest corners of India, which otherwise is
Mhm.
not possible. It's been so long that capital markets have been doing well, but I'm sure there are a lot of
Mhm.
pockets of India or a lot of investors, even in large cities, who've not been
Mhm.
able to access services of best of the wealth managers. Now, with 5paisa Wealth and few other platforms like this emerging,
Mhm.
I'm sure it will make the whole concept of financial planning and managing their wealth very accessible to a lot of these investors. On
Mhm.
top of this, curated portfolios or advisory portfolios, as we call it, I think is a phenomenal product because
Mhm.
it brings together on one hand some of the very experienced portfolio managers like ourselves, and at the
Mhm.
same time helps us to provide our advisory services to investors at probably the lowest possible cost. So investors get access to the advisory of some of the best fund managers or portfolio managers with very deep experience at a very
Mhm.
low cost, and more importantly at a very the whole execution is absolutely seamless, digital, and in one click. So it's
Mhm.
completely hassle free, which
Mhm.
one would not have thought about being possible in India 20 years back when there was no digitization. So
Mhm.
I feel very excited about the whole opportunity, and I think it's a win-win for investors, both from a what 5paisa Wealth can offer, and more
Mhm.
importantly for even curated the opportunities which and the value addition which these model of curated portfolios can do to investors' portfolio.
Mhm. Absolutely. I think everybody who listens into this will be in full agreement. And I really like that point which you brought up about financial inclusion, right? In the sense that a lot of people today don't have access for various reasons. Maybe it's the cost, maybe it's the transaction size, or maybe it's just inability to access these sort of curated portfolios. And through platforms like this, we can now invest in portfolios created, like you said, by experts like yourself who've been in the industry for more than 25 years. I think previously, such sort of, forget maybe 10 years back, even maybe about 7, 8 years back, before digitization actually took over, these sort of opportunities were absolutely not available to investors.
Yeah, absolutely. I completely agree with it, with you. And more importantly, I think the beauty of these advisory portfolios is they're completely
Mhm.
transparent. So, well, I have been a great proponent of mutual funds because I've spent a large part of my career in the mutual fund industry in India. But unlike a mutual fund where the investor just buys a fund and he gets units of funds, here he
Mhm.
buys individual stocks and he can
Mhm.
see each, and they're completely transparent because each and every transaction happens in investor's account. So he
Mhm.
can see each and every transaction and he knows actually what's happening with his portfolio in each and every stock. So
Mhm.
not only brings the best of the advice to the investor, but it's a product which is very transparent. Probably I would, on transparency, I would rank these portfolios as to be much higher than that mutual fund as well. You know,
Okay.
and at the same time, they're coming to investors at a cost which is probably lower than that of a mutual fund or equal to that of a mutual fund, which again brings the best of all. The investor gets best of all the worlds in terms of the best manager or a best experienced portfolio manager, high transparency, and probably low cost. So I think it's just a great product from an investor's point of view.
Like you pointed out, a win-win for every stakeholder in the equation.
Absolutely.
Perfect. So, Pankaj, I think maybe we can talk about one of the first solutions on this platform, your Alpha Core and Satellite portfolio. I believe you have a presentation to share with us. So, can we discuss how this portfolio is managed? What is the philosophy and how it can add value to our investors?
Oh yeah, absolutely. So let me just run you through you and all the audience through a very brief presentation, giving insights into the portfolio and the thinking process and how the performance has been of this portfolio over the last few years that this portfolio has been into existence, and then probably
Certainly.
we can take questions.
Certainly, sir.
Just allow me a minute to adjust my
Sure.
screen. I trust my screen is visible.
Not yet, sir.
Oh, just give me a sec. I trust my screen is visible now.
Yes, it is.
Okay, thank you. So, friends, I'm very happy to share with you, the Alpha Core and Satellite portfolio, which is advisory portfolio or a curated portfolio, as we call it, and it's available on the 5paisa Wealth platform. Over the next few minutes, I would like to take you through the thought process behind this portfolio. It's a fundamentally curated portfolio by a research team. Just to give you a small background before we start talking about the portfolio, but a quick background of the economy. I think last 18 months we've seen a very sharp recovery. We've seen a very sharp recovery in the economy. While last year was a year of sharp contraction, but after that, as economy unlocked last year, we have seen a very sharp recovery in the economy. And this year also, while wave two had some impact in terms of on the economic impact, but it's not been very significant. And the good thing is the economy is unlocked after wave two. We've seen very strong recovery in the economy. So we remain very bullish on the outlook for Indian economy. Our view is that this year probably India will have a 9.5, 10% growth, and more importantly, India will reach a sustainable double-digit growth by 2024-25. And that will be a very significant event because the last time India reached a double-digit growth of 10% was in 2010, and after that we have not seen that kind of a growth. More importantly, what we're essentially seeing is, a lot of people have some concerns that the markets have risen very sharply in the last 18 months. So is there a bubble or is this rally sustainable? I firmly believe that we are in a very strong bull market. All of you will understand that or will appreciate or agree with the fact that at the end of the day, from a fundamental perspective, equity markets are driven by the earnings of the nifty companies or the company's profits. One very interesting phenomena that we are seeing is if you take the last decade between 2010 and 2020, Nifty earnings actually doubled over a period of 10 years, which effectively means they were growing at a CAGR of about close to 7% over a period of 10 years. But what has really happened is now the same thing, what took 10 years to happen, the same Nifty earnings are going to double in the next 4 years between 2020 and 2024. So effectively, Nifty earnings will be growing at 19% per annum over the next 4 years, and we're already in the middle of it. So if uh, if you accept that logic, then whatever returns Nifty has given in absolute terms over last 10 years, because the Nifty earnings doubled, in absolute terms, the similar returns should happen in the next 4 years, right? Because Nifty earnings or the profits of the Nifty companies are growing at a much faster rate, or two and a half times what they've grown in the last decade. And if that be the case, then that is what underpins this strong bull market. And you apply this to the current Nifty, then our view is that Nifty should get to something like 25,000 by 2024, which is about another 2 years time from here on.
Okay.
Given the fact that India has had a very strong bull market in the last 18 months, we still believe that Nifty can do a 15% CAGR compounding returns per annum from here for the next 2 years, which is very healthy. So the point I wanted to share with you, friends, is this rally in stock markets is driven by very strong underlying fundamentals. Markets can correct for a brief period of time, but overall outlook for markets remains extremely healthy.
Okay.
Uh, Coming to our Alpha Core and Satellite portfolio, the idea behind Core and Satellite portfolio is very simple. Generally, it's been our experience that one of the common refrain which most of the investors experience is they invest into equities or they trade into equities. They make money, but at the same time, they are not able to take that money home, because eventually, some point of time, the bull market ends and investors end up losing a lot of the money they make. So a lot of investors have us say that we make money, but we are not able to take that money out of the markets. The Alpha Core and Satellite portfolio designed to address exactly that problem which investors face, where we are running two portfolios in the same under the same umbrella. One portfolio is a core portfolio. This is a portfolio of companies which are very high quality in their characteristic. These are high quality companies which are going to deliver very strong earnings growth over the next 5 years, and they are very fundamentally sound companies. And the portfolio intends to hold these companies for a 3 to 5 year time horizon. So that forms the core of your portfolio. And at the same time, so these companies will keep giving multi-year compounding returns to investors as their earnings keep growing, in line with the economy and in line with the markets over the next 5-10 years. And at the same time, we run another portfolio in the same umbrella, which constitutes about 25 to 30% of the overall portfolio, which we call a satellite portfolio. The
Okay.
idea with satellite portfolio is it's a slightly more short to medium term portfolio where the investment is made with a time horizon of 6 months to 12 months, and we are
Okay.
looking at companies or stocks which will deliver high returns or healthy returns over the next 6 to 12 months. And as soon as our profit objective is met or price targets are achieved, we will sell those stocks. So we'll ensure that there is a regular profit booking and probably move on to some other stocks. So what this does is it will ensure that there is a profit booking at regular intervals. Uh, you know, so within the umbrella of one portfolio, investors get benefit of both long-term investing, which is the core portfolio, and short-term or medium-term investing and regular profit booking discipline, which is the satellite portfolio. So it just brings
Sure.
best of both the worlds to the investor. Yeah. As I said, so the core portfolio is something like about 70% of the portfolio, and it's a portfolio in which we invest in very high quality companies, which are essentially leaders in their respective industry. And these companies have very strong profit growth, very high ROE, and very strong business moats or competitive business edge. And these companies are meant to be held for a slightly more longer term perspective, which is 2 to 3 years at least to start with, and can be longer as well. So these are essentially our portfolio compounders where we expect to compound our capital and create wealth. And on the
Sure.
other hand, we create a tactical short-term portfolio, as I share what I call the satellite portfolio, which could be about 30% of the portfolio, which is companies which are likely to do well, where the stocks are likely to do well over the next 6 to 12 months. And as soon as we achieve some price targets on these stocks, or our desired price objective is achieved, we will rather book profits in these stocks and move to something else. So that's the satellite part of the portfolio. As
Sure.
I said, these are companies which are very high quality growth companies. It's a multi-cap portfolio, so about 60% of the portfolio will be into large caps, and the balance 40% will be into mid and small cap. And as I said, these are the typical investment horizon for this portfolio is about 3 years. Just couple of final points as investors. When we invest, our philosophy is growth bias. So essentially, I firmly believe that equity is an instrument to create wealth. When we buying into equity of a particular company, we become partial owners of those companies. And for us to make money, the underlying business of that company has to grow. So as investors, we're always chasing growth business or businesses which are likely to deliver high growth from over the next 3 years, 5 years, 10 years. Because faster the growth, probably faster should be the value creation or the wealth creation for investors. So we're always chasing growth, but more importantly, we're also chasing good quality growth. We don't invest into poor quality businesses because then obviously there is a risk of loss of capital if the underlying business quality is poor because that business might not survive in the long term.
Sure.
One final word of caution, generally investors have this notion that if you want to generate high returns in equities, then you have to take high risk because unless and until you take high risk, you will not generate high returns, right?
Right.
But what I would like to share with you, friends, that the relationship between risk and return in the world of equities is not linear. That the higher the risk you take, the higher the returns you generate. That's not the case. The relationship between risk and return when it comes to equities is, I'm sure all of us have studied in a school, it's a bell-shaped curve, which effectively means that if you take high risk, after a particular point of time, there is a marginal decline of utility, which effectively means the higher the risk you take, your returns start declining because you start investing into very high risk companies, and then those companies will destroy your capital at some point of time or other. So the path to generating high returns in equities is not by taking high risk, it's by taking moderate risk, or as we call it, reasonable risk. you know
Understood.
and experience tells us that investors who take reasonable risk or what we call moderate risk are investors who generate healthy returns or high returns over a medium term to long term. So always remember, equity is a risk asset class. It's very important to make sure that we are not taking more than adequate risk when it comes to world of investing, because if you take higher risk, you might end up investing into a lot of high risk companies which might not survive. Whenever there is a downturn in the market or there's an economic shock, just like we had a COVID shock, and something
Right.
else might just happen some point of time in the future. So the
Sure.
path to generating high returns in equities is through uh, reasonable risk or moderate risk, and not through high risk. People who take high risk will eventually end up losing their capital or destroying their capital, and will eventually generate low returns and not high returns. So that's very briefly on the portfolio construct and the philosophy of core and salad portfolio. I'm happy
Sure.
to share with you the performance of this portfolio as well. Since inception, this portfolio was launched in June 20. I'm very happy to share these numbers, performance numbers as of end of September, 30th September 21. This portfolio has delivered a return of 96% over a period of 15 months versus the underlying benchmark, which is Nifty 200, which is 83%. So it's outperformed the underlying benchmark by 13%. When we compare this portfolio with most of the mutual funds in India, then over this period, it's been one of the better performing funds, having beaten most of the mutual funds in India. So that talks about the performance of the fund. The fund has done extremely well. Last 3 months, the fund is up 13% versus the 15.3% versus underlying benchmark of 11%, 11.9% returns. And all of these returns are coming by taking what is more important is by taking reasonable risk. We are not taking very high risk with the portfolio because all the companies in the portfolio are companies which are business leaders. Effectively, they're leaders in their respective industry. So, which
Sure.
effectively means that when the market falls, these companies will be falling much less. This is a brief snapshot of the portfolio. So if you see the sectoral breakdown, about 29% of the portfolio, it's a very well diversified portfolio. About 30 odd percent of the portfolio is into financial sector, and 15% into IT consulting and software, and there's 10% into automobiles, and so on and so forth. And you can see the top five holdings in the portfolio. So the some of the leading holdings of the portfolio has holdings into companies like Aditya Birla Fashion and Retail, Bharti Airtel, State Bank of India, Indian Hotels. Each of these companies, as I shared with you, every company in the portfolio is leader in their respective industry. and
Sure.
these are companies which have done well, and we are very optimistic on their performance outlook going forward. Just to add here, there's a very deep and very detailed fundamental research that goes into selecting each and every company in the portfolio from our end, from our research team. So these are very fundamentally oriented portfolio with very deep research. In nutshell, the idea with core and satellite is to, all of us understand that uh, uh, equity, meaning equity is about risk, and we should not fear that risk. What is important is to manage that risk well. So the
Right.
objective and investors who can manage that risk well are the ones who will generate superior long-term returns in equities, and which is what exactly the objective with core and satellite portfolio is, to focus on superior risk-adjusted returns. So take reasonable risk and yet generate very healthy and superior returns for investors over the medium term to long term. Yeah. Uh, uh, Myself and my research team have won multiple awards, multiple points of time. We've been ranked as one of the best investors and some of the leading fund managers in India. So I thought I'll just show you a snapshot of that or give you a glimpse of that as well.
What is it?
And
Right.
today, I feel very happy that through our same research effort, we are able to connect with and bring our best of portfolio management and research capabilities to investors across whole of India and maybe probably globally as well, which would not otherwise have been possible had this model portfolio and 5paisa wealth platform not been there.
Right.
So I'm really excited about this product of advisory portfolio, and I'm really happy that 5paisa Wealth is taking this initiative to take these portfolios and products to investors across length and breadth of India. Thank you very much, friend. I'll pause here and I'll be happy to take questions.
Thank you, Pankaj. Thank you very much. You make a very compelling argument, both for the current satellite portfolio and the entire platform and the way these portfolio advisory services are available. Just maybe a couple of things, if I could, discuss with you. One is. I really like that point which you brought up in terms of risk management and how, like you said, our mindset is key. Higher risk equates to higher return. That is all of and what you're saying is key. After a certain point of time, higher risk actually does not equate to return. It probably eats into your return. On the contrary,
Exactly,
right?
exactly.
So from that perspective, can you right? So from that perspective, can you maybe throw a little bit light on how this portfolio manages risk?
Yeah, so I'll give you an example. Let's say housing finance is a sector. Now, all of us know that housing
Sure.
finance is a sector has done very well in India in the last 10 years. And given the fact that so many millions of Indians still don't own a home, and which they will buy over the next 20 years as India keeps growing, housing finance companies do well, right? So the outlook for housing finance sector is very bright in India. But see, from an investor's point of view, when we are investing into equities, on one hand, you have one of the best housing finance company in India, like HDFC, and we
Right.
had a housing finance company called Diwan Housing, which
Right.
all of us know could not survive and was taken over through the bankruptcy code now recently by Piramal Capital, right? So if one was in a great sector like housing finance, you can still get a badly managed company like a Diwan Housing. I'm saying
Right.
this because if anyone was a shareholder of Diwan Housing Finance, which many people were, they lost 100% of their capital because the equity became zero. So the point I'm trying to say is when we are looking at any company, we have to look at as to how strong is the business of that company and whether that company will survive economic shocks or crisis will keep happening every few years. There was a
Right.
COVID crisis. Before that, there was a trade war between US and China that happened few years before that.
Right.
And all I'm saying is the world is full of crises. Every few years there will be some crisis or other.
Sure.
When we invest, we have to make sure that the business model of the company and the management running that company is strong enough to weather any such crisis. And which again is a function of very deep fundamental research that our research team does day in, day out. While they analyze companies and then they make a judgment on the companies as to how strong or resilient those companies are in terms of their business models and so on and so forth. And then we finally take a call. one of the key aspects of the core and satellite portfolio is we invest only in companies which are industry leaders. So if you have to invest in housing finance, then will you
Mhm.
invest in the top three housing finance companies in India?
Okay.
The beauty of being a leader is that if you're a leader in a particular industry, then you are amongst the
Mhm.
best player in that industry, and you will never go out of business. You know,
Mhm.
so again, make sure that it's a low risk or a moderate risk portfolio, which is what exactly we want to do.
Sure. So, from that perspective, is this also applicable to the satellite part of the portfolio in the sense that these are, I think you mentioned, more tactical and shorter term in nature, right? So, for the core part, of course, we go into in-depth fundamental analysis and look at the growth and revenue and numbers, right? What is the approach for the satellite portion of the portfolio?
So when it comes to and managing a satellite portfolio,
Mhm.
this is a very interesting question. Yeah, we do not dilute the quality standards of the portfolio.
Okay.
We still apply the same stringent quality standards while building the satellite piece of the portfolio. But
Mhm.
it's just that satellite portfolio are companies which have a short-term tailwind for them, which could be 6 months, 12 months, or 18 months, and maybe not 5 years. For example, let's say
Mhm.
over the next 6 to 12 months, we think steel prices will remain strong. So steel
Okay.
companies will do well, right? So, but
Okay.
we know that steel prices will remain strong for the next 12 or 18 months, and we don't know what will happen after 18 months. We can't take a
Mhm.
5 year view on steel prices. So then,
Sure.
if you want to buy into steel companies, they
Mhm.
form part of a satellite portfolio and not the core portfolio. Because core portfolio is companies where we have a 3 to 5 year view on their business and their growth outlook. Satellite are
Mhm.
companies where we have a view which is more like 6 months to 18 months kind of a thing. But then, even when we are investing into steel sector, we'll
Mhm.
invest in some of the best companies or the leaders in the steel sector. We'll not invest into bad quality companies. So we'll
Mhm.
never dilute the quality of our portfolio because that is very
Mhm.
important for us. Yeah, because I
Mhm.
firmly believe that the first principle of investing for investors is capital preservation. Rule number one is don't lose your capital, don't
Right.
risk your capital. And then the
Mhm.
rule number two is don't forget rule number one. So as the famous investor Warren Buffett always keeps saying, yeah. So the
Mhm.
first thing
Correct.
is as investors we have to preserve our capital, and the one of the key
Mhm.
principle or key principle of preserving capital is invest into good quality companies. Don't invest into poor quality companies or companies with poor fundamentals, because then you can
Mhm.
lose money at some point of time or other. So
Right.
while the approach to satellite is different, but from a quality perspective, we do not dilute our quality standards while selecting or building our satellite portfolio.
Thank you. I think that is really good to know because generally, I think again the perception for the satellite or tactical portion of a portfolio is that you chase momentum, and in the bargain sometimes compromise on quality. But what you're saying, and correct me if I'm wrong, is that quality still remains of utmost importance. But the tactical portion looks at maybe stocks which are qualitative and can have short-term triggers, and you try to capitalize on those short-term triggers.
Absolutely, absolutely. Even if we are chasing momentum, we are chasing
Mhm.
momentum in quality stocks and not poor quality stocks. We are chasing momentum in good quality stocks. So very clear that the portfolio has certain quality standards which we will not dilute under any circumstances, because we cannot afford to take any risk with our capital. Our capital is extremely precious. For any investor, capital is a raw material on
Correct.
which you build your wealth. So you cannot
Right.
lose your raw material, because then how, if you lose your capital, then how do you build your wealth? So
Correct.
we will not dilute our quality standards because capital is extremely precious for us.
No, it's good to know because I'm sure you'll agree from a retail investor perspective, and also because, like you said, these are new products, right? It's not something like a mutual fund is something yeah, we all know about it, but these are new products. तो सबसे पहले the thing which comes to your mind is कि अच्छा इतना return मिल रहा है तो इसमें risk क्या है? Right, so it's very important to kind of have this discussion where our investors and listeners understand that risk is well managed and quality is not diluted at all. So
Exactly. And the other
that's
point is, often I have seen in my experience of managing mutual fund money in India over the last
Mhm.
25 years, I have met so many retail investors across, right from Chandigarh to Trivandrum and
Mhm.
from Tinsukia to Solapur. I've traveled across length and breadth of India. selling mutual funds. What I've seen is investors, when they're investing or trading on their own into stock markets, they end up buying a lot of poor quality companies because उन्हें पता नहीं है कि दीवान हाउसिंग फाइनेंस कंपनी खराब है और एचडीएफसी अच्छी है. They cannot differentiate between good quality and poor quality, and which is where a professional manager or an investor, like ourselves, step in to make the difference, to make sure that you're not buying poor quality company. It really pains me from my experience when I see investors losing money in poor quality by investing into poor quality businesses, because investors are naive, they're gullible, and they are not able to, make that distinction. And at times they get carried away basis whatever advice they get from whatever friends, families, or something like that. So I think what it now this curated portfolio does is it allows investors to access the services of experienced professionals and probably avoid those kind of traps.
Perfect. Right. Pankaj, I have one last question for you. It's more holistic in nature. Given that these are new products, what do you think from a retail investor's perspective? What portion of their portfolio should be allocated to such sort of curated portfolios?
I would like to think over a period of time, the allocation of investors' portfolio to these kind of products should be at least be as much as mutual funds in their portfolio. They should switch some part of mutual funds to these kind of products, because, as I said, the beauty of this product is, one, the transparency level here is far higher than that of a mutual fund. Because in case of mutual fund, you do not know what the mutual fund has done during the month in terms of what stock they've bought and they've sold. You don't get to know. Here you know exactly each and every transaction and each and every trade. So the transparency level as far as advisory portfolios are concerned is far higher than that of a mutual fund. Secondly, it gives the investor the discretion. So when an advisory portfolio is created, unlike a mutual fund where in a particular fund there are 40 or 50 stocks, in an advisory portfolio, if the investor doesn't want to buy one or two stocks out of the 20 stocks those are recommended to him by the advisor, he can always exercise that discretion by not buying those stocks. Which is not possible in case of a mutual fund, because in a mutual fund, when you invest into a fund, you buy all the stocks of the portfolio. I'll give you an example. For example, one of our clients was a software engineer, and when he bought one of our advisory portfolio, and our portfolio had some IT companies like TCS and Infosys, and he was of the opinion that another smaller IT company will give him a higher return than TCS. I said that could be right, but as a philosophy, this portfolio invests only into industry leaders. We don't invest into companies we are not comfortable with. But he said, no, I am comfortable with this IT company. So instead of buying TCS, he bought that other IT company and he bought rest of our portfolio. So now something like this discretion is not available to an investor when he invests into mutual fund. So it gives investor an option to customize the portfolio if he wants to.
Okay, that's interesting. So that's another very interesting point. So, just in terms of how this functions transactionally, so if we, as an investor, if I buy this portfolio, then all the recommended stocks in a certain weightage, as prescribed by the advisor, will get credited to my demat account directly.
Absolutely,
Right?
yes. Yeah.
And if there is rebalancing, the advisor, you will directly then inform the investor that these need to be rebalanced. And then the investor can choose to either rebalance as per the advice or maintain the current allocation.
Yeah, absolutely. So the discretion is with the investor, because we are just the advisors. But whenever we think that a particular stock has reached its target price, we certainly would like to take book profits and move to some other stocks. So we'll rebalance the portfolio. At times, we are because we are very fundamentally oriented. We are researching these all the portfolio companies on a continuous basis, and we are tracking the quarterly results of these companies. We are also talking to the management of these companies on a regular basis. So whenever we think there's an adverse news flow or a poor result by any company, and as a result of which we need to, sell a particular stock, we will act promptly and immediately to make the necessary changes to the portfolio. And then the investors will receive the notification immediately, and then meaning while the option is with the investors whether they want to rebalance or not,
Mhm.
we
Mhm.
certainly advise them to rebalance, because whenever we are making changes to the portfolio, we are making it because there are very strong reasons for it.
Right.
Uh,
Mhm. So,
so yeah, investors are well advised to follow the rebalance. This is like going
mhm.
to a doctor and not following the doctor's advice. It can be at times be injurious to your health. So likewise, not
Correct.
following your advisor's financial advice can be injurious to your financial health.
Perfect. I think that is also a good note to maybe tie up our session. With not listening to your portfolio advisor's advices injurious to your financial health. But thank you, Pankaj. I think this what you and Five Paisa together are doing in terms of launching this advisory platform where every investor across board can get advisory from expert professionals like you. That is extremely potent. It can go a long way in creating wealth for investors. And thank you very much for taking this initiative and extending these services through these platforms, and also for being here and walking us through the portfolio.
Thank you so much. It's indeed been a pleasure. I'm very excited about this whole platform of 5paisa Wealth that 5paisa has brought together. And I'm very sure that it will go a very long way and build a very large benefit investors, a large population of investors in terms of making wealth services accessible to them.
Absolutely. And thank you also, listeners, for tuning in today. It's been wonderful hosting you. And for everybody who would like to explore this further, please do log into the 5paisa platform. Do check out the core satellite portfolio. And if there are any queries, always, of course, feel free to reach out to us. Thank you very much.
Thank you
Thank
very
you, sir.
much. Thank you.